Well, now that 2022 is coming at an end, official reports state that record inflation and the U.S. Federal Reserve's aggressive rate hikes left their mark on the American economy in 2022. But is there an end in sight? The Fed and Chair Jerome Powell had repeatedly said in 2021 that inflation was transitory, before debunking that myth late last year and signaling a monetary tightening cycle. Although analysts thought the Federal Open Market Committee, FOMC, was too late to shift course to tame inflation, most economists did not anticipate rate hikes would come so fast and so steep. The U.S. Central Bank had said in its March 2021 meeting that inflation continues to run below its target of 2%, but the following month said, inflation has risen, largely reflecting transitory factors. Powell, in July 2021, had said inflation increased notably, and it will likely remain elevated in coming months before moderating. However, it was December 1, 2021, in testimony before Congress, that he said it is time to stop describing inflation as transitory. The word was finally dropped by the FOMC 2 weeks later in a monetary policy meeting. At the FOMC's March meeting, the Fed began its monetary tightening cycle with an interest rate increase of 25 basis points, followed by a hike of 50 basis points in May behind the curve in inflation fight. Despite the rate increases, consumer and producer inflation figures continued to climb in the U.S., raising concerns that the central bank was already behind the curve in its fight against inflation. Producer prices soared to an annual gain of 11.6% in March, while consumer prices jumped 9.1% in June on an annual basis, both recording their highest levels in more than 40 years. The record figures forced the Fed's hand to make more desperate moves, using its most powerful weapon, more aggressive rate hikes. The Fed increased its benchmark interest rate by 75 basis points June 15, its steepest rate hike in 28 years. From June through November, the FOMC made 4 consecutive interest rate increases of 75 basis points, followed by another of 50 basis points December 14, carrying the target range for the federal funds rate to between 4.25% and 4.5%, its highest in 15 years. No end in sight. It is, however, unclear when the FOMC would decide to pull its foot off the throttle and slow the pace and intensity of rate hikes. Powell said November 2 that there are some ways to go with rate hikes, and the ultimate level of interest rates will be higher than previously expected. The chair, in his last post-meeting news conference, said that more macroeconomic data is needed to prove inflation is falling. It will take substantially more evidence to give confidence that inflation is on a sustained downward path, he said, as price pressures remain evident. He, however, admitted that the American economy slowed from last year, while job vacancies remained high and wage growth elevated. Recession worries. The Fed's aggressive monetary tightening, on the other hand, has been decreasing the money supply in the markets in the U.S. and global economy in general. The amount of liquidity declining in the markets has been so rapid and so steep that there have been fears of a recession in the world's biggest economy, which could also spill over to the global economy next year. Although the Fed is trying to avoid triggering a recession with its rate hikes and achieve a soft landing, even Powell admits that the process would not be easy and the runway is getting shorter. The International Monetary Fund said in October that recession fears have grown as central banks have strongly shown their resolve to fight record inflation, and warned that a sharp tightening of financial conditions could send the global economy into recession in 2023. The IMF recently lowered its global economic growth forecast for 2023 to 2.7%, down 0.2 percentage points from its previous forecast, while it said there is a 25% probability that the global economic growth in 2023 could fall below 2%. U.S. economic growth for the third quarter came in at 3.2%, according to the Commerce Department's third and final reading released last week. The American economy contracted at an annual rate of 0.6% in the second quarter, after shrinking 1.6% in the first quarter of 2022, year-on-year. More and more banks and economists are leaning towards a hard landing in 2023 as high interest rates start to bite. But a recession is not a done deal yet, even though the U.S. economy is on thin ice going into next year. After a rapid interest rate hiking cycle by the Federal Reserve, macroeconomic data is finally showing signs of cooling, with the biggest hit to the economy yet to come. On a more bearish side, JP Morgan has warned the recession is very likely next year. Our view is that market and economic weakness may occur in 2023 as a result of central bank over-tightening. with Europe first and the U.S. to follow later next year. JP Morgan's chief global markets strategist Marko Kolanovic said in his 2023 outlook, "While there is significant uncertainty on the timing and severity of this downturn, we think that financial markets may react sooner and more violently than the economy itself." Bank of America forecasts a recession in the first quarter of 2023, with the GDP falling 0.4% next year. The bank forecasts the unemployment rate to rise to 5.5% and inflation to fall to 3.2% by 2024. UBS is also calling for a recession in 2023, citing high interest rates and projecting near zero growth for the U.S. next year and in 2024. "We think the U.S. expansion is headed for a hard landing," UBS chief U.S. economist Jonathan Pingle said in the 2023 outlook. "We expect the Fed to continue tightening policy through the first quarter of next year, with the Fed funds rate peaking at 5.25% this cycle. That said, we do not expect the Fed to cut rates immediately at the first sign of weakness. Specifically, we expect the committee to stay on hold for the rest of 2023, and we look for the first rate cut in Q1 2024, the bank said. Capital Economics is looking for the U.S. to enter into a mild recession next year, with the Fed forced to cut rates before the end of 2023. The GDP is expected to rise 0.2% over the next year, and core inflation to slow to 3.2%. We expect the lagged impact of higher interest rates to push the U.S. economy into a mild recession next year. Although that downturn will be accompanied by only a modest rebound in the unemployment rate, we expect both headline and core inflation to fall rapidly, eventually convincing the Fed to begin cutting rates before the end of 2023, Capital Economics said in its outlook. Can the Fed reach 5% next year? Billionaire bond king Jeffrey Gundlach sees the Fed moving another 50 basis points in February, with rates potentially peaking at 5% next year. But what's more important is that the Fed won't be able to keep rates at that level for more than one meeting and will be forced to cut. You get to 5%, you repeat it, and then the market thinks it will start falling, he said. The bond market is pricing in that the Fed funds rate 1 year later will be the same as the Fed funds rate at the December meeting. This leads me to wonder why even bother with these hikes. Dig a hole just to fill it back in. Gundlach even warned that the Fed might not even make it to 5% as the data is weakening too rapidly. The Fed moving rates up so quickly is not usually good for stable policy, said Gainesville Coin's precious metals expert Everett Millman. The U.S. economy will fluctuate widely from that.